Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. Joining me today would typically be Mr. Michael Becker, the governor of the great state of Texas, but he's on an interesting due diligence assignment. We'll talk a little bit about that in a second. But joining me in the podcast today, the professor himself, Mr. James Zhang. James, how are you?
I'm doing great, Paul.
So, give people an idea. We're here live in San Diego, and we're in the shadow of the U.S. Navy, North Island. We see the Coronado Bridge. We see the beautiful Pacific inlet of water. We see a lot of ships going by. And so what are we doing in San Diego, James?
Yeah, so once a year, we have, 10,000 of our closest friends convene on one place. Last year was Vegas. This year was San Diego. And so we got to get a little sunny weather. And basically, people set meetings every 15 minutes to talk to debt and equity and operators and property managers all throughout the country and figure out what the hell is going to happen this year.
Yeah, 2024, we're in San Diego, the National Multifamily Housing Council meeting. This is at the Grand Hyatt. Again, as James says, 10 to 12,000 apartment investors across the board, whether they are debt people, equity people, operators of multifamily housing. Everybody has a story to tell from their individual perspective, but also the region that they're in. It's usually a 3 or 4 day conference, and we stepped out of the crowd. And let me just kind of set the picture for you. This is a huge conference. And it's really for somebody this is what they do. They're a professional real estate, either investor, lender, equity person, developer, management company, everything that you can think of that has to do with residential, multifamily, some student housing, some senior housing. Everybody has a story, and we listen to some of the folks that are telling their stories. So you could come join us. You'd have to pay $5,000, $6,000 to come out here, or we could just set the table and talk a little bit about what some of the things people have discussed, give you kind of a matter-of-fact ideas of what's going on out there. And so, James, we sat down, we had a number of meetings with people, we visited with a bunch of folks throughout the country. Well, let's talk a little bit about some of the things that we're hearing or what they're saying that you think is important for somebody that maybe is an individual investor that wants to get into multifamily. What are you hearing today?
I mean, we didn't see, a lot of times people bring a little briefcase or a little luggage, and, brokers will typically bring 5, 10, 20, 30, 40 deals to NMHC and really launch them here and start selling them to all these different investors. But the briefcase was a little bit lighter for this year. I mean, we saw groups that were bringing maybe 2 or 3 deals to the market here in the next couple weeks. And so the briefcase was a little bit lighter in terms of sellers out there and guys who are wanting to go right now.
Yeah, I mean, James is absolutely correct, is that you usually see the launches for the whole year start in January. These are the multifamily properties, whether they're A, B, or C properties that a lot of people want to try to get to NMHC because, like, if you are in Dallas and you are a broker in Dallas and you maybe are an investor in North Carolina or Chicago that want to have an exposure to Dallas, you meet, spend time with, get to know the economics of that area, and then the brokers spend time with you, if you're an investor, to kind of give you kind of a general overview about what's going on in this specific deal. And just like James said, very light this year, very light with inventory. A lot of these folks, these brokers from all these different areas, are not bringing a lot of opportunities to show people of what's going on out there. Are we at the bottom, James? What is your take about the market itself?
I mean, you've got to, everyone has a different perspective on it. Listing brokers are saying, this is the bottom, it's time to go. Other maybe lenders and other people in the industry, they're quite not there quite yet. And so some people want to see a little bit more blood in the street and see a little bit more distress, whether that means foreclosures, whether that means short sales, and start seeing some of that stuff clear. before they jump back in. And so, I think a common theme is equity. And when equity steps back in, whether it's institutional equity or syndicated equity, it's actually pretty hard to raise, is what we're seeing. But, for the right deal and the right price, equity's there.
So we talked with a senior guy last night. That's part of a DUS lender. They're one of the 25 DUS lenders. And we were just having a conversation as we were having something to eat with them. And one of the things that they were saying is that we asked them is, are we at the bottom? And his feedback as he was shaking his head, we are not at the bottom. And so the question is how do we know that we're not at the bottom? What were some of his comments?
Yeah, I think he wants to see more of this stuff, the distress to clear. And so if you have a $20 million loan and, everybody's bidding 18 or 17, it's, you're going to have to come in with a new bridge loan or a modified bridge loan or a loan assumption or something to really clear that deal. And that's where you'll start seeing pricing sort of bottom out, because it's not going to get any cheaper than that. But it's not an easy deal to take over. Most of these deals that are in distress, the reason they're in distress is the occupancy is 60%. And, the tenants aren't paying. So even the 60% that are there, they're not paying. So it makes it more challenging to get that cash flow up. So we're seeing some workouts, some modifications of loans, and, new equity, but also new general partners coming in to fix some of these deals.
It kind of reminds me of a song that somebody sang in my ear last night. Buyers want to buy, sellers want to sell, but truth of the matter is sellers don't want to sell. So not really at these prices, sellers do not want to sell. They want to hold on to these assets for as long as they can. They're very much concerned that if they sell right now, there's going to be economic repercussions. Not only are they selling maybe at the bottom of the market, which we don't think is the bottom of the market, or selling into a market that's going to get even more soft, but they don't want to sell possibly because partnerships may have tax reasons, economic reasons, that when they got into the class of 2020, 21, and the class of 2022, that put equity in these deals, they took advantage of the bonus depreciation, and if they give this property back to the bank or it becomes a foreclosure, there may be some economic reasons of tax problems that they're going to have too. What else are you seeing out there, James?
Yeah, in terms of owner-operators that came out, they want to buy and they want to start getting some of these discounts, but they're bidding 6% on the cap rate on a lot of these deals, and the seller's still stuck at 525.
Right.
And so a lot of transactions, the ballpark number we heard last year was really, let's say 200 deals in Dallas that were listed, maybe half of those made it to closing. And so it might be a little bit more of that this year in terms of people don't know if they put a deal under contract for $30 million, can I raise $10 million right now with a 60% loan to value Fannie Freddie deal?
Yeah, let's break down maybe some of the things that by industry groups, in the equity groups. One of the things I heard, we have to put money to work because we've been on the sidelines for 18 to 24 months. We got to do a deal. And that really speaks to the heart of a lot of these private equity groups that, maybe the Blackstones or some of these other big private equity groups that have not made investments in the multifamily in the last 24 months, and some of the people that work for them that have been putting money into these deals over the past 10 or 12 years. How do you justify your job if you're not really putting money to the deal? So when all the senior managers come down, well, how do we pay this guy $300,000, $400,000, $500,000 a year if he really hasn't done anything or she hasn't done anything?
Yeah, we've bought zero deals, so I can do that on my own. I don't need someone to tell me to buy zero deals. So, I think those guys are going to be a little bit more itchy to come out and get some deals done. But it all comes down to the guy sitting back at headquarters who's going to write the check. Who's going to write the check for the equity.
So when we're looking at, there's 10, 12,000 people. I don't know how many there was. It is packed. We had to step out just to have a conversation with you because if we were inside, you couldn't even hear yourself talk. It was that crowded. People are on top of each other. I kind of call it the blue suit group because everybody has blue suits, maybe a white shirt, khaki pants, open collar sometimes. But it is, I would say, 95, 96% men, 4 or 5% women. But one of the things I thought I really liked this year, and I don't think it was announced until later, that they're trying to encourage more women to get into the business. More women, we're encouraging more women to get into this business.
Yeah, I mean, I think like all industries, real estate's getting older. The people in the industry are getting older, and they want some new blood in the space. And so they're trying to encourage. I mean, we definitely saw more people maybe who are MBA students when we flew over from Dallas. A couple of people from SMU were on the plane. We saw some people from University of Chicago. So people coming in from all over the place, and they're just getting started in their real estate journey to some extent, and they're here.
Yeah, last time that they saw is when they were in 7th and 8th grade. So they're analysts. They're the first level tier of people trying to bring these deals into senior management that maybe have gone through 1 or 2 or 3 cycles, have seen what's going on. But a lot of young faces, a lot of young people trying to get in this business. It's tough because right now with the cycle almost collapsing a little bit, to kind of justify a lot of these jobs that are administrative jobs, second tier jobs. They're not making decisions, but they're trying to encourage more people to come in, that maybe in the future that they'll be senior people. So my feedback is younger people are here. They're participating, trying to tell you their story. As a guy who's done this for 38 years, I always enjoy people that haven't been through a cycle or two of what they think, because the only thing they've seen for the last, say, 4 or 5 years has really been positive. And the second biggest thing is women. More women are coming into this business. The National Multifamily Council is encouraging them, especially to take advantage. If you can, maybe next year, you can come out and take a look and just see what's going on. So we saw a lot of folks participating. A lot of the parties were just jammed the last couple of nights. And when they're done talking and preaching about multifamily, again, this is a huge networking opportunity for people that come out here. And a lot of the groups, whether it is Newmark or Marcus & Millichap or is Lument or Arbor, if you're a good participant in doing business with them, they bring you to a cocktail party and everything's for free, and you have great conversations with people that surround the industry. So this is it's education, it's understanding, but it's a social piece that, as we say, Michael Becker says, you got to do business with people that you know, like, and trust. So this is a way to start meeting people if you're getting onto this journey. What else do we learn about any of the equity players or anything else?
Yeah, I mean, this is sort of in between the debt and equity, is that, when we're talking to operators, a lot of people, the equity is hard, they get that. But then on remember on your Fannie and Freddie loans that we've been doing the last 12 months, is you've got to have people sign with you. You've got to have people with the net worth and liquidity and the experience to sign with you. And if your deal has gone bad in the last 6 to 12 months, or even going bad right now, it's going to be hard for you to do that. And so we're seeing people who have had more trouble bringing on additional guarantors to meet that net worth and liquidity, or they might just be on a check with Fannie and Fannie can't give them a new loan. And so it's going to be a little bit of a challenge. And so we're going to need some new people in the class of 24 to come out and start buying some of these deals, it sounds like.
Yeah, the class of 21 and the class of 22. So if you were an LP investor and you saw your friends making money in multifamily real estate between 2017, 2021, and then you decide, hey, listen, I've missed the boat for all this time. I'm going to double down. I'm going to get into to put money into these multifamily deals in 2021, 22, and you double down. To be honest with you, you are handcuffed today if you invested in a lot of these transactions. Is that, a lot of these deals prior to that, people were to buy these properties, put a lot of money into rehab the properties, be able to push up the rents. The cap rates were falling, so the values became greater, and that their business plan said that we're going to sell the deal in 4 or 5 years, but they actually sold the deal in 1 or 2 years, and they got that 22 or 23%, and I put that in quotes, air quotes, rate of return, and so they executed their plan, and everybody made money. Well, today, if you were in the class of 21, 22, and you put the money in, you're locked in. So that you're not getting the money out anytime soon. Hopefully that you haven't lost your money, but hopefully your GP has been able to either find more money to either buy a rate cap or modify the loan to extend the loan out for another couple of years. Because one of the things that we learn in real estate, the longer you can hold these properties, it kind of is the safer it is. But if you have to go when you have to go quickly now, it's going to be difficult to try to make money if you are not in the right economic means, meaning that cap rates are expanding, interest rates are going up, there's no new additional capital that's available for other people to buy your deal. What else, James?
Yeah, I sort of want to go back to Well, I'll touch on one thing. I think the Fed held today.
Yeah.
And so, I think a little bit of buzz. I mean, people have sort of accepted that the Fed's going to cut in March or May. It seems like those are two big bets, is what the market is saying. But, one of the memos Howard Marks had, I think, in January, and I like this part of it a lot, is when we were talking about the cycle, he sort of breaks it down into steps. And the first step is you have rate cuts that bring on easy money. And then the problem with that is it reduces prospective returns, which, think about your savings account in 2021, it was zero. And then, so it leads to willingness to bear increased risk. And so a lot of people in 21 and 22, they were looking at deals and saying, well, I've got 0% in my savings account, and this guy's telling me 15%. Like that, I had almost no opportunity cost to take the money out. But right now, when it's sitting at 5% on treasuries or 5% on your money market, you have an opportunity cost there, and people are it's harder to get that money. I can't remember one guy we were talking about, the number of calls he had to make just to raise, let's say, $1 million to put in on a cash in refi. He had to go pretty deep into his list of people just to get that $1 million. But eventually, what happens in all cycles is essentially, those decisions, those investment deals in 21 and 22, it's going to lead to some losses, which is going to bring, and this is where we're at right now, to me, is a period of fear, stringency on lending, tight money, and economic contraction. And so that's the part of the cycle that we're in right now. And that's why, as much as, usually this event is sort of a kickoff the year, let's start going, everybody has that in the back of their head, is that the last 2 years, 3 years have been tough, and not until we get some rate cuts and easy money again, which was the first thing in the cycle, are we going to see everything start coming back. And so we haven't had that, and so a lot of people are waiting for those rate cuts. Even though the first one, they give us 25 basis points, it's not going to change the world on your floating rate deal, but it's more of a signal. It's a signal to investors. It's a signal to everybody in the market that we're done, and that the peak of interest rates is gone. So
we talked a little bit about the equity that's been on the sidelines. It still remains on the sidelines to a certain extent. Let's talk a little bit about the brokers. I mean, those are the salespeople in the organization. Those are the ones that are always positive. They're always telling you that the sun's going to come up tomorrow, which it has been for the last billions of years, and the sun comes up. So they've always been positive. What are some of the things that the brokers, who are always positive, have been saying out there? Well, one of the things that I picked up, and I'll throw this over to James, not a completely different world in 2024 than in 2023. James, what else?
Yeah, I mean, I think, it's more reality for a lot of people, and it's sort of a come to Jesus moment in 2024 for a lot of these guys, because the maturity's coming, and you're going to have to put up, 2 or 3% of the loan amount for an interest rate cap. And if you don't have that money, the LPs don't have that money, then you've got to sell. And so we're seeing people who are trying to essentially sell for the loan amount. And if you can go for the loan amount, these guys are ready to go.
Well, yes. I mean, we talked with a guy today that was telling us a story about a buyer that wanted to purchase 27 assets from a distressed seller. 27 assets from a distressed seller. So buyer wanted to negotiate with the seller. So, the seller really had nothing to do with it. So the buyer started to have conversations with the lenders that the current seller was in business with. And, the buyer found that, I'm trying to take your 27 problems off your hands. Well, the lenders were like, no, thank you. We're not going to cut or discount our unpaid balance for you to try to take it out. So we are not going to negotiate for a lower unpaid balance than what is currently on there. So, yeah, the seller is getting wiped out, but the buyer couldn't negotiate with the lenders because, again, the lender was like, we can take it over and maybe do a better job than this guy can. So the lender's not playing, at least right now, at least in that scenario where they were trying to take over a 27 unit or 27 property portfolio.
Yeah, I mean, maybe I should start with this, was 2024 is the year of the refi, because if you as an owner can't refi your bridge loan, then you're going to go through those steps. You're going to try to list it, and then you're going to see if you can get something above the loan amount. If you can't get something above the loan amount, then you're going to have to kick the can more and get the interest rate cap and extend the loan. And so you're going to have some sort of workout with the lender, because most of these deals cannot hit the debt yield that is on the loan agreement to make that extension.
The brokers also said to us that the national meetings that they had with some of the large private equity firms like Blackstone and other groups like that were very positive, that they really want to start buying, again, to justify some of these people's jobs. But there's really not a lot of inventory out there. It's like what we said before, the inventory that a lot of these brokers brought, they really are not in a position to allow these folks to go. Like we talked about about 2 months ago, we had a conversation with one of our senior vice presidents with a large multifamily appraisal group, and he did a great job. And he was telling us is that there really has not been a lot of bridge lenders that have come back to them to ask for opinions of value. Give us an appraisal. We'll spend $5,000. Some of the sub-servicers, the servicers that really, they manage these assets after the loan has been originated, the loan's on their books, and then the problems start to happen with these loans, and then the special servicers come in to try to take it over. Well, my question really is are you starting to see a lot of these special servicers ask for opinions of value? And 2 months ago, it was like, no, we're not really seeing them asking us to figure out what the value of their collateral was. Yesterday, we had a conversation with another appraiser and she runs the entire division of a large company for nationwide on multifamily. I asked that same question. She goes, Paul, in the last month, in January, we're starting to see a lot more requests come in from these special servicers wanting to know what the heck their property collateral is worth. There may be some pain, but where two months ago it was kick the can a little bit down, extend and pretend. But today I think some of the special servicers are really starting to figure out that we may have to sell these assets if these borrowers are in too much distress and they can't solve their own problems by bringing in additional equity. James, any more?
Yeah, on the A stuff, I would say there's enough to clear to figure out a cap rate. The B stuff, there's enough to clear. But on the C stuff, that's the hardest thing probably, is trying to figure out the cap rate on a C deal. We've seen some smaller deals get under contract, probably, close to the 7 plus cap rate in the DFW area. So I think that's the story on appraisals is, probably 5.25, 5.5 on an A deal if it does clear. B deal probably close to 6, and then C deals 7 plus. And so if interest rates sort of stabilize, I think, and people can underwrite that and sellers are willing to go, I think there'll be a lot more transactions.
What are you seeing, James, with, we walked through today, yesterday, the day before, we walked through this huge crowd and we saw a lot of faces that we recognized from Facebook and LinkedIn and all the things that they've been marketing for the last 2 or 3 years. And a lot of these GPs have owned a lot of assets, and now those assets are not doing too well. Is a lot of them are just dead man walking? How do they keep reinventing themselves to be at events like this that they want to continue to buy? What's your 2 cents about some of these?
I think
stories?
I think people who started, let's say 10 years ago, let's say 2014, they put wins on the board. So they bought stuff in 14, 15, 16, 17, 18, and they put wins on the board for those investors. And so they have a pretty long track record in the space. I get it. It's been bumpy. 21, 22 have been bumpy for a lot of these guys. And so I think we saw less general partners come out than in 21 and 22. But, I think some of these guys, they're just trying to figure out ways to get it done. And they're, the IT job or the engineering job was a long way away from here. So they're going to do everything to fight and claw their way in this business. And they have a lot of deals that are still performing. So I don't think it's, we see in the news maybe 1 or 2 deals go bad, but, they might have 20 or 30 other deals that are doing fine. So we're not going to send the new pitch to the guys that we lost their money, but we're going to send it to the other 80% of the guys.
Yeah, absolutely. A lot of these people are working damn hard to try to fix some of the problems, that whether it was they caused it or the market caused it. But they're trying to do what they can do to try to save these deals and continue on. Whether they have to refinance it to get extended terms so it doesn't have a problem with a short maturity. So we're talking with them and kind of figuring out what their game plan is and what they're going to do and how they see the light at the end of the tunnel. But a lot of them, some of them, there was a couple dead men walking that we walked through, and I'm always amazed that they pop up, and it is what it is. Anything else with the buyers or the brokers out there?
Yeah, I mean, I think what's unique is everybody's a little king in their little city. If we're gonna pick a city, I'll just throw out Dallas for us. And when we walk around, we see everybody from Dallas, and we know everybody from Dallas. But we'll also have conversations with people from Nashville. We'll have people from, middle of nowhere America, and they're here. And, they have the same forces at work in terms of interest rates and Fannie and Freddie and all that stuff. But I think what's interesting is guys who own in other markets that are trying to come to Dallas, they're using a different approach. And sometimes that approach doesn't work. So they're used to, maybe they're used to buying stuff in New York, and now they're using that same approach to come down to Dallas. And, we had to walk a couple of guys through this in terms of how to do that and the players that you need to know and who you need to be introduced to. And so I'm going to give a soft plug for the field trip. And, as people, whether they're, trying to buy in Dallas or trying to invest in Dallas, I think knowing all the players in that market is going to give you a huge leg up in this market of 24.
Yeah, the Dallas DFW Multifamily Investors Group, again, is hosting another field trip. Now, it's just not Old Capital, but it's a lot of the brokers in the area, some of the general partners, some of the attorneys, just to give you an unbiased approach about what's going on. And we could have 200 or 300 people join us, but we want more of an intimate setting. It's a 2-day event. First day is study. It's classroom, going through different ideas about what's going on out there, just to give you an overview how to calculate NOI. We start with some of the basics, and we play this LOI strategy game, which is fantastic, that James has, that I really think you should come and watch how that's played, because it's always funny is that the input from some of the classroom people were like, I didn't realize I was getting brokered on this deal, that I was bidding against myself. And you see how some of this stuff works out. So the first day is really classroom. You understand a little bit more about multifamily. Second day is we actually get you out, and then we have you talk with some of the general partners and what they do, how they manage these assets. You actually physically are on property, A, B, and C properties, and that we feed you for a couple days, and then we call it a day. And it's really to get people, not general partners, but to get limited partners, just to give them a general overview, not slanted, about really what's coming on or what's going on today. We give you a history of what's going on, of what the good, bad, and the ugly, and then two is there opportunities in the future for just buying distressed assets. Again, we don't really have a dog in the hunt. We just want to educate you, and I don't want to see anybody lose any money. James, when is that field trip again?
So Wednesday and Thursday, middle of April, so April 17th and 18th. We'll put a link on the podcast website, or you can just go to oldcapitallending.com and hit subscribe and get your name added to the email list, and then we'll put a link as on the email that goes out next couple weeks.
Yeah, we've been here for 3 days in San Diego, enjoying the beautiful weather. We are outside again because it was jammed with 10,000 of my closest friends from all across the country talking about real estate. We've had a great time. Any final thoughts, James, before we say goodbye to everybody? And what else was your takeaway?
No, I think 2024, everybody's hoping for more transactions, but because that's how a lot of people in this business get paid, is transactions. But I think it's going to be a lot of behind the scenes fighting, not necessarily fighting, I would say negotiating with lenders, negotiating with equity, because a lot of these deals where you just need more time. Interest rates have moved so fast. And who knows? I mean, it went up so fast, it could come straight back down. It's going to change the game really quickly. And, when 10-year hit 5% last year and now it went all the way down to 3.75, I mean, the sentiment in the market changes that fast. And so I think if you aren't in position, you're going to miss this window to buy deals. And so I think right now, for the GPs that I talk to, I'm like, you should be focusing on equity every day, But then at the same time, you need to be touring deals, you need to be walking deals, you need to be talking with brokers, because when a deal does pop up, you got to be ready.
Well, thanks, James Zhang. We appreciate the professor giving us a little insight. Again, we are in San Diego. After 3 days, I think we're ready to go back to Dallas. And so we're live at the Grand Hyatt Hotel at the Conference Center in San Diego, overlooking the beautiful bay here in San Diego with 10,000, 12,000 of our favorite multifamily friends. So again, I'm Paul Peebles. James, thanks for coming along. Have a good day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.